Welcome to Truth Behind History. If you're curious about how money evolved from shiny bits of metal to the paper and digital currency we use today, you're in the right place. Money is one of the most powerful forces shaping human civilization. But here's the thing, it wasn't always little green bills or numbers on a screen. The story of money is a story of innovation, stability, and, of course, controversy. In this video, we'll take a journey through time, exploring how money transitioned from gold to fiat currency and what that means for the world today. So, sit back and get ready, because understanding money isn't just about history, it's about power, control, and the future of the global economy. Let's start at the very beginning. Ancient commodity money, long before banks, credit cards, or even coins, early civilizations relied on something called commodity money. This wasn't money in the way we think of it today, it was anything that had intrinsic value and was widely accepted in trade. Think gold, silver, salt, or even cattle. The key idea here was that these items were valuable on their own. If you had a gold nugget, you had wealth. If you had a cow, you had wealth. It was simple, tangible, and universally recognized. Now, this system worked well, to an extent, but it had problems. Imagine trying to carry around a herd of cows every time you needed to make a trade, hardly convenient. Or what if your trading partner didn't want gold but preferred something else? The inefficiencies of barter and bulky commodities led to an important financial breakthrough: standardized currency. Adoption of the gold standard. Fast forward to the 19th century, and we see the rise of gold-backed currencies. This was a game changer. Instead of carrying gold itself, governments began issuing paper money that was directly tied to a fixed amount of gold. This meant that every dollar, pound, or franc could, in theory, be exchanged for a set quantity of gold. It created a sense of security. Money had real value behind it. No government could just print endless amounts of it without having the gold to back it up. Sounds perfect, right? Not quite. While the gold standard provided stability, it also limited how much money governments could put into circulation. If an economy needed more money to grow, but the gold supply was fixed, economic expansion could be stifled. This rigidity would later cause major problems, especially during economic crises. Transition to fiat currency. By the 20th century, the world faced economic challenges that the gold standard just couldn't handle. Countries needed greater flexibility in their monetary policies, especially during times of war and financial crisis. So, governments began shifting toward fiat currency, money that has value simply because the government says it does. Unlike gold-backed money, fiat currency isn't tied to a tangible asset. A $20 bill is only worth $20 because we collectively agree that it has purchasing power. This shift gave governments the ability to expand the money supply and stimulate economic growth. But there was a catch: without the restraint of gold, printing too much money could lead to inflation, devaluing the currency over time. This transition set the stage for modern monetary policy, and as we'll see, it wasn't without consequences. Now that we understand the basics, let's dive into one of the biggest turning points in financial history: the gold standard and the Great Depression. Now, here's where things start to get really interesting. The gold standard might have sounded great in theory: stable, reliable, backed by something tangible, but in times of economic crisis, it became a straitjacket. And no period tested the limits of the gold standard more than the Great Depression. Economic contraction. During the early 20th century, economies around the world relied on gold-backed money. That meant that the amount of money in circulation was directly tied to how much gold a country held. But when the Great Depression hit in the 1930s, this system made things worse. Here's why: in a normal economic downturn, governments today would respond by printing more money, lowering interest rates, and stimulating spending. But under the gold standard, they couldn't do that because every dollar needed to be backed by actual gold reserves. So instead of expanding the money supply to help struggling businesses and unemployed workers, the government was forced to keep money tight. The result? Worsening deflation, skyrocketing unemployment, and an economy stuck in a downward spiral. Think of it like this: imagine a burning building, and the only way to put out the fire is with water, but you're only allowed to use as much water as you have stored in a tiny bucket. That's exactly what happened during the Great Depression. Abandonment of the gold standard. Governments realized they needed more control over their economies, so one by one, they started abandoning the gold standard. The United States took a major step in 1933, when President Franklin D. Roosevelt suspended gold convertibility, meaning you could no longer exchange dollars for gold at a fixed rate. He even made it illegal for Americans to personally hoard gold, forcing them to turn it in for paper money. This move was controversial, but it gave the government the ability to increase the money supply, helping to reinflate the economy. Other countries followed suit, and by the end of the 20th century, the gold standard was essentially dead. Bretton Woods system, but wait, gold wasn't completely out of the picture yet. In 1944, a new monetary system was introduced, called the Bretton Woods system. Under this agreement, the US dollar became the world's dominant currency, and other countries pegged their money to it. The catch? The US dollar was still tied to gold, meaning other nations could exchange their dollars for gold held by the United States. This system worked for a while, but as global trade expanded and the demand for dollars grew, the US simply didn't have enough gold to back up all the money in circulation. Eventually, in 1971, President Richard Nixon made a bold decision. He ended the dollar's convertibility to gold, effectively making it a fiat currency. That was the final nail in the coffin for the gold standard. From that point on, money was no longer backed by precious metals, it was backed by trust in governments and central banks. But while fiat currency gave governments more flexibility, it also introduced a new set of challenges, especially the risk of hyperinflation. And if you want to see what happens when a government prints money without restraint, look no further than Zimbabwe. Now, if you ever need a real-world example of what happens when a government loses control of its money supply, Zimbabwe is the textbook case. Hyperinflation isn't just some abstract economic concept, it's a financial disaster that destroys economies, wipes out savings, and leaves people scrambling for basic necessities. And Zimbabwe's experience in the early 2000s was one of the most extreme cases in modern history. Uncontrolled money printing. So, what went wrong? In the early 2000s, Zimbabwe was facing an economic crisis. The government, led by President Robert Mugabe, was struggling with debt, sanctions, and economic mismanagement. Their solution? Just print more money. Now, printing money sounds like an easy fix. More money means people can buy more things, right? Well, not exactly. If you increase the money supply without increasing the amount of goods and services in the economy, prices start to skyrocket. And that's exactly what happened. Zimbabwe's central bank flooded the economy with new banknotes, leading to a catastrophic devaluation of its currency. Extreme currency devaluation. To put it bluntly, Zimbabwe's inflation rate exploded. And when I say exploded, I mean numbers so ridiculous they don't even sound real. By 2008, inflation peaked at 89.7 sextillion%. Yes, sextillion. That's 89 sextillion 700 quintillion%. At that point, prices were doubling every 24 hours. Imagine going to a store, seeing a loaf of bread cost a few thousand Zimbabwean dollars, coming back the next day, and finding out that same loaf now costs millions. People had to carry entire bags of cash just to buy groceries. At one point, Zimbabwe was printing $100 trillion bills, which were still barely worth anything. Savings accounts became worthless overnight. Workers were paid in stacks of cash that lost value before they could even spend it. It was economic chaos. Shift to foreign currencies. Eventually, Zimbabweans lost all faith in their national currency. Businesses and individuals abandoned it completely, turning to US dollars, South African rand, and other stable foreign currencies just to survive. In 2009, the Zimbabwean government finally gave up and officially stopped printing their own money. This is what happens when a government prints money without limits. It's a powerful reminder of why trust in a currency is just as important as the money itself. Now, let's step back and compare fiat currency to the gold standard. Is one really better than the other? Let's break it down. So, after everything we've covered, you might be wondering, which is better, the gold standard or fiat currency? Well, the answer isn't so simple. It depends on what you value more in an economic system. Let's compare the two. Stability versus flexibility. The gold standard was stable. Since every dollar was backed by a fixed amount of gold, there was no risk of governments printing endless amounts of money. That's why people who support the gold standard argue that it prevents reckless spending and forces governments to be responsible with their finances. Fiat currency, on the other hand, gives governments flexibility. If there's an economic crisis, a government using fiat currency can print more money, lower interest rates, and stimulate growth. Under the gold standard, that wasn't an option, meaning recessions often dragged on for much longer. So, do you prefer long-term stability or short-term adaptability? Inflation control. One of the biggest criticisms of fiat currency is that it requires constant management to prevent inflation from spiraling out of control. With the gold standard, inflation was naturally limited, money supply could only grow if more gold was discovered or mined. But fiat currency? It's entirely controlled by central banks. If managed correctly, fiat currency can support sustainable economic growth. But if governments print too much money, like Zimbabwe did, it can lead to hyperinflation and economic collapse. It's a balancing act. Monetary policy control. This is where fiat currency really has an advantage. Governments using fiat money can actively manage their economies through monetary policy. They can adjust interest rates, print more money, or intervene in financial markets. Under the gold standard, governments didn't have this power. They were stuck with whatever amount of gold they had, meaning their hands were tied during economic crises. That's why many countries abandoned the gold standard when times got tough. So, what's the verdict? Well, both systems have their pros and cons. But as history shows, most countries have chosen fiat currency, despite its risks, mainly because it allows for more economic control. But what if there was another option? What if we could have the best of both worlds, something as limited as gold, but as digital and flexible as fiat money? That brings us to the rise of digital gold, cryptocurrency. Now, imagine a world where money isn't controlled by governments, isn't printed endlessly, and isn't backed by gold, but instead exists entirely in digital form. That's exactly what cryptocurrency, often called digital gold, aims to be. Let's break it down. Decentralization. One of the biggest problems with fiat currency is that governments and central banks have complete control over it. They can print more money, change interest rates, and manipulate economic conditions. Cryptocurrency, like Bitcoin, is designed to remove that control. Instead of being managed by a central authority, Bitcoin runs on blockchain technology, a decentralized system where transactions are verified by a global network of computers. No single government or institution can just decide to print more Bitcoin or change the rules overnight. This makes crypto very different from traditional money. It's trustless, meaning you don't have to rely on a central bank to keep things in check. The system runs itself. Scarcity and inflation control. Remember how the gold standard prevented governments from printing endless amounts of money? Well, Bitcoin works the same way. Unlike fiat currency, which can be printed at will, Bitcoin has a fixed supply of 21 million coins, ever. This built-in scarcity makes Bitcoin similar to gold. There will never be more than 21 million Bitcoin, which means, in theory, its value should increase over time as demand rises. Unlike fiat money, which loses value due to inflation, Bitcoin's limited supply is designed to resist inflation entirely. But there's a catch: adoption and volatility. Adoption and volatility. Even though cryptocurrencies have been around for over a decade, they're still a relatively new concept. Governments, businesses, and individuals are still figuring out how to use them effectively. And let's be honest, crypto markets are wild. Prices can skyrocket one day and crash the next. One tweet, a government crackdown, or a major hack can send the entire market into a tailspin. This extreme volatility makes it hard for people to trust cryptocurrency as an everyday currency. While some see Bitcoin as the future of money, others see it as a high-risk asset that still needs time to mature. So, could crypto replace fiat money? Maybe. But before that happens, we have to look at what governments are planning to do next, because they're not going to give up control so easily. That brings us to the future of money and the rise of central bank digital currencies. As we move further into the digital age, one thing is clear: money is changing. But the future might not be as decentralized as crypto enthusiasts hope. In fact, governments around the world are working on their own digital currencies, designed to keep money under their control. Let's take a look at what's coming. Central bank digital currencies, CBDCs. Governments have seen the rise of cryptocurrency, and they don't want to be left behind. That's why many central banks are developing CBDCs, central bank digital currencies. These are digital versions of traditional money, controlled by governments, but using some of the same technology as cryptocurrencies. The idea is simple: instead of using cash or traditional bank deposits, people would hold digital currency issued directly by their country's central bank. Transactions would be fast, secure, and trackable. Sounds efficient, right? Well, here's the big question: how much control should governments have over people's money? With a CBDC, authorities could monitor every transaction, freeze accounts instantly, or even enforce spending limits. Some see this as the next step in monetary evolution, while others worry it could become a tool for financial surveillance. Decline of physical cash. No matter where you stand on CBDCs, one thing is for sure: cash is disappearing. The rise of digital payments, mobile wallets, and cryptocurrencies is making physical money less relevant. Think about it: when was the last time you paid for something with cash? Many businesses are already going cashless, and some countries, like Sweden, are moving toward eliminating paper money entirely. This shift makes transactions easier, but it also means people are more dependent on digital banking systems and government-controlled money. Economic and regulatory challenges. So, what happens next? the future of money will be shaped by a balance between innovation and control. If cryptocurrencies continue to grow, governments may either adapt or crack down on them. At the same time, CBDCs could provide stability, but at the cost of privacy and financial freedom. We're at a turning point. Will money become fully digital? Will governments maintain control, or will decentralized systems like Bitcoin take over? Only time will tell. But one thing is certain, the debate over gold, fiat, and digital currency is far from over. And that brings us to our final thoughts. So, what have we learned? The history of money is a story of power, control, and adaptation. We started with commodity money, where gold and silver were the backbone of trade. Then came the gold standard, which gave money stability but limited economic flexibility. That system collapsed, giving way to fiat currency, which allowed governments to manage economies more freely, but at the risk of inflation. We saw what happens when governments lose control, like in Zimbabwe, where hyperinflation turned money into worthless paper. And now, we're entering a new era, where cryptocurrency challenges the traditional system, and governments respond with their own digital currencies. So, which system is best? Gold? Fiat? Crypto? The truth is, each has strengths and weaknesses. Gold ensures stability, but limits economic growth. Fiat gives governments control, but risks inflation and debt. Crypto offers decentralization, but struggles with volatility and adoption. And the future? Well, digital money is coming, whether we like it or not. The question is, who will control it? One thing is certain, money is never just money. It's a reflection of power, trust, and economic philosophy. And as history shows, it's always evolving. If you found this video interesting, don't forget to like, comment, and subscribe to Truth Behind History. What do you think? Is fiat money doomed? Should we go back to gold? Will crypto take over? Let me know your thoughts below. And if you love exploring history, check out my other videos for more deep dives into the events that shaped the world. Thanks for watching, and I'll see you in the next one.